If you've been in the market to purchase a home, you've probably had some tough conversations with your mortgage broker. Interest rates have had their biggest 3-month increase since 1994. At the end of December in 2021, the average 30-year fixed rate mortgage was at 3.11%. Today, Freddie Mac just came out and said that the 30-year fixed rate mortgage is at a 4.67%, and that's with points. And I'm just talking about a normal conventional loan. Once you get into the jumbo loan category, which most people in Orange County, California are in, you're looking at interest rates in the low 5s. It's safe to say it's been a wild start to the year. And unfortunately, things are not settling down anytime soon. Mortgage rates are driven by inflation, and when inflation goes up, so do mortgage rates. And the inflation problem in our country is much worse than the mainstream media would have you believe. I follow Barry Habib very closely. He is a mortgage guru in this industry that many of us look up to, and he has predicted many of the market cycles that we've been in the last 20 to 30 years. He suggests strongly that we'll hit a recession by the end of this year or early 23. There are 3 indicators that he looks at. The first one is an inverted yield curve with a 10-year yield and the 2-year yield. When the Federal Reserve raises their Fed funds rate, the 2-year yield goes up and the 10-year yield comes down. The Federal Reserve has already raised their Fed funds rate by 0.25% this year, and they are indicating more rate hikes, even 50 basis points at their next meeting. What they're trying to accomplish is slowing down the economy. The second indicator that Barry Habib looks at is the unemployment rate. What he looks at is the unemployment rate is at its lowest level, and as the economy starts to slow down and people stop buying stuff and spending their money, then business becomes slow, and owners of these businesses have to start laying people off. It's that turn that he looks at for the unemployment rate. He says that when we hit that turn, we're about 6 months away from a recession. The third indicator that he looks at is the Federal Reserve's balance sheet. Historically, when the Federal Reserve raises their Fed funds rate, mortgage rates actually tend to trend lower. But the Federal Reserve has suggested that they're going to allow their $9 trillion balance sheet to run off. And the market is reacting to that. Historically, in a recession, housing has always done very well and mortgage rates have actually gone down. With the exception, of course, in 2008, when mortgages were actually the problem and the creator of the recession. But mortgages are much more regulated now, and housing remains strong amidst all of this change. My suggestion, if you are in the market to buy a property, is look into adjustable rate mortgages. The rates on an ARM product are much lower than a 30-year fixed rate, and they're costing a lot less up front, especially if you're in the jumbo loan category. So let's say you take a 5-year ARM, and in the midst of those 5 years, we hit a recession and mortgage rates go down, you can refinance that mortgage into a 30-year fixed rate. There are a lot of different loan programs that you should be looking at today outside of the 30-year fixed rate. Let's talk about your options. There are a lot of moving pieces. Thank you for listening and have a great day.